All right, so gold and silver are pretty much down today. And if you take a look at the prices, gold has, at the time of this recording, shot down from around the 1860s all the way down to the low 1840s. Silver was at 25.59, shot down currently at the time of this recording to 25.30. Now, this is one of those moments when we actually become somewhat short sighted by just looking at two assets that you can possibly trade within the market. The reason why I mention this is because there's something happening overall when it comes to this business of buying and selling assets. And within the overall markets, we're starting to see some overheating a little bit. And one of the easiest markets to kind of take a look at to see how traders are behaving is obviously the stock market, equities. It's just easier to see or to just get information to see what's going on within the markets from buyers and sellers. Now, who are some of the biggest players when it comes to moving prices? Well, obviously, it's not us retail traders, it's the institutions. So a lot of institutional, investor behavior, we should definitely take note of. And when it comes to gold and silver, obviously the same thing can be said about the movements within gold and silver. So let's just take a look at what's been happening recently when it comes to just general trading within the S&P 500. Now, what I want to do is actually expand our horizon a bit and take a look at a chart of the S&P 500 extending back 5 years. And the reason why I'm doing this is because I'm also taking a look at trading volume over that period of time. And what you tend to see is that on average, month to month, trading volume, pretty much averages around 60 billion, 70 billion, 80 billion monthly. Monthly, you'll have a trading volume of 60, 70, 80 billion, maybe sometimes 90 billion. And when 2020 hit, obviously we had some selling volume, a lot of selling volume. And soon after, we had prices rising, and we still had pretty high volume within the markets monthly. We were in the 100s territory. We weren't in the 60s, 70s, and 80 billions anymore. We were in 120 billion, 131 billion, back in June. We dropped down to 97 billion in July, 84 billion in August, and then 92 billion in September. And we start to see some prices dropping there. 89 billion in October, started to see some prices dropping there. And then prices started shooting up a lot more, obviously, because of the the election in the United States. It started jumping up to about 100 billion, but now it's starting to kind of tail off a little bit. We're at 96 billion, and currently within January, we're at 64 billion, but January isn't up yet. We still need to have that month finish out. But the reason why I bring up volume so much is because when it comes to tenets of, let's say, for example, Dow theory, whenever we see prices and valuations go up, it also is somewhat of a support when you see volume trend up as well. But when you start seeing volume trend down while prices go up, that is somewhat of a, I don't want to say bearish signal, but it's not one that leaves you with much confidence. When you start to see prices go up and volume dip out, what you can somewhat assume is that, well, or maybe you can start questioning is, well, are there going to be enough buyers when I want to sell at these high prices? Because if there are high prices and I can't sell, then I have to bring my prices down to accommodate the minimal amount of buyers within the market. And things become a buyer's market very, very quickly when prices just start to drop. Now, another reason why I think we should be a little bit more hesitant when it comes to the markets right now is because investors, large institutional investors, are actually holding less cash right now. And some have actually said that, well, that's actually a sell signal. Now, check this out. Investors' cash holdings as a percentage of total portfolios are now at 4% on average, according to Bank of America's latest fund manager survey. Again, that's fund manager survey, not retail investor survey. So December figures basically have a decline from November's reading of 4.1. So we've been on a decline in cash holdings for institutional investors down to 4%. Now, why that's a problem is because the last time cash reserves were this low, it was right before the crash in March. Now, obviously, there is an external event that happened right at one of the worst times for fund managers because their cash reserves were so low. That's why liquidity was such a big issue. Liquidity is always an issue when it comes to the markets. If there isn't enough liquidity, you can't sell at the price that you like, and the prices will have to come down to accommodate what the buyers are willing to pay for it. And they will know because they'll know that you're stressed out and you're willing to just get rid of that asset at any price. So currently, fund managers have their cash reserves at 4%. And finally, why that is a big deal is because Bank of America actually says that historically, when investors' cash allocation falls to 4%, the S&P 500 declines an average of 3.2% in the following month. So basically, what we should be expecting, possibly, is a decline within the S&P 500. And because there's so little cash available, that's one of the reasons why. And because there's so little cash available, you also have to understand that that will impact gold and silver as well. It's not just equities that'll be beholden to this, but gold and silver will also be impacted by this if there aren't enough institutional investors to buy in to make those prices go higher. So just one thing to take note of during times like these, not just looking at the daily motions here, but I'm just talking about overall within the last month or so, maybe even next month, things to look out for. So for me personally, what I've been doing actually is I've been telling you I've been trading equities. I have gold and everything, but within my equities portfolio, I actually have, it's almost, I want to say, a third in cash. And my portfolio actually isn't that volatile. The risk to reward ratio is pretty good. The Sharpe ratio is pretty good, but just make sure that you have enough cash to take advantage of some of the dips that we will be seeing in the market if Bank of America's assessment holds water and we start to see some dips in prices. All right, guys, let me know what you think in the comment section below. Thanks again for watching. Please hit that like button. Please subscribe if you're new. It's Black Bullion for goldandsilvertoday.com.